Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Charles Lemonides of ValueWorks. Charles and I have a conversation about his investment philosophy. He is obviously considers himself a value person, considering the fact that he named his firm ValueWorks. I enjoyed speaking with him because he's got a very diverse take on investments. And, the comment that sort of stood out to me is he said something along the lines of, it's your job as a portfolio manager to put together a series of uncorrelated bets. And I don't think that is something that is, or different bets, right? And I don't think that that's necessarily something that is groundbreaking, but I think it's good to hear. And I think that as you hear him talk about the different names in his portfolio, you will see that he tries to implement what he's saying in a way that he understands. So I hope that you take some learnings out of this conversation, and it is a conversation that I didn't exactly expect to have when I researched his portfolios, but as we got into it, I found it fascinating. Hope you enjoy. As always, nothing in this show is financial advice. Please consult an investment advisor before making investment decisions. Everything in this show is for entertainment purposes and educational purposes, and do your own due diligence. All right, ladies and gentlemen, thrilled to be joined by Charles Lemonides today of ValueWorks. Charles, how you doing?
Good. Nice to be here with you, Bill.
Well, I appreciate your time. I know that you said that your background is not too exciting or whatever, but I was curious if you could let people in. A little bit of background always helps start the conversation and level set on where we all are.
Well, that's a picture of the Empire State Building poking through the clouds in Midtown. We are right now coming to you from One World Trade Center on the 84th floor. Let's see if we give you a picture outside. I doubt it'll show much, but yeah, you can see.
Yeah,
there's the
nice.
Verrazano Bridge in the distance, and the whole
That's
team
nice.
out there plugging away.
You started ValueWorks. How did you get into all this? Why is the firm named ValueWorks? How'd you get into value investing, and how'd you cut your teeth in the industry?
Well, I started out thinking that a career on Wall Street would be exciting and fun and good for my skill set. I did some work on trying to figure out what career paths were. I started in a research department doing the most mundane research humanly possible, but learning a lot, and was lucky enough to have a couple of mentors who were really, really good at assessing businesses and investments. And didn't end up starting ValueWorks for another. I started in 86 after graduating college in 84, and started ValueWorks sort of in 99 in 2001.
That's a good time to start something value-based, right?
Well, I never liked the term value investor historically because to me it connoted low quality businesses at cheap prices. There was an article I read, some fabled value guy said, well, value had a bad year last year because financials and tobacco stocks did badly. Like, tobacco stocks and financials aren't definitionally value. Value is, in the real world, there's something worth more money than I'm paying when I buy this security. And to me, it occurred to me that value is not buying low-priced businesses cheap, but rather caring about price when you start your investment process and saying, look, what are the assets underneath this investment worth in the real world? And am I paying more when I buy this stock or less than that amount? And that to me is value.
I would agree with that definition. I think a quant might argue, but I would say that they're playing a slightly different game than what we're talking about, right?
Yeah, look, it's a philosophical approach of how you look at investments. It's not purely metric driven. Any metric could show an instrument is not a value, is not priced according to a value metric, but a different metric might say it is. And if you're just using a metric, you're not getting the whole picture.
Yeah, I would agree with that. Do you specialize in certain types of companies or industries? How do you think about where you'll go as an investor?
What I find the best investment opportunities are where you can find something that is a real growth opportunity and it's trading at a value price. And the key to our success over the years is building portfolios with a lot of those in there. And they're all different from each other, so that in any given period, one or two of them can come into favor, and that carries the whole portfolio. So our portfolios will have 25, 30 long names in them, but within those 25, 30 names, there are really 15 that are very, very different from each other.
Yeah. And I had noticed, just based on your 13F, it seems to me that you currently have a bit of a concentration in energy. Though I was going through your historical 13Fs, and it looks like that is more of a growing into a concentration than something that you necessarily put on at cost, if I can say it that way.
You have that exactly right, Bill. We had an amount of energy exposure coming into the COVID meltdown. But in that COVID meltdown of 3 years ago, I guess, oil prices went negative and security prices on energy, everything in the energy complex became completely divorced from long-term values. And so we ended up buying 4 or 5 really, really low priced instruments that we were confident were the right place in the capital structure. So you'd come out the other side. And I don't think we put 8% of the portfolio into those 4 or 5 names because they were so volatile and had so much upside. And those names they've gone up, 5x to 25x. And so, yeah, our challenge now is scaling those back.
Yeah, I was just going to ask that. How do you think about sizing a position like that in the beginning, and then how do you think about scaling them back? Like, how do you think about the portfolio management when a position grows that large, just sort of conceptually?
Well, we talk about starting our position sizing at 3 to 6%, and that's a central place for us. But a central investment for us is pretty stably valued. Some of our core investments include Comcast and Goldman Sachs. These names can earn us great rates of return, but they're stable and solid names. When things get really dislocated, we'll tend to buy more names in a space at smaller percentages, really thinking of them as almost one investment or two investments. So a year ago, this month, I guess, or last month, when the regional banks, and all their securities started collapsing, I think we bought 4 or 5 different instruments of 3 or 4 different companies, preferred stocks and debt that were at anywhere from 35 to 60% of the face amount. Each one of them, we did the analysis that the underlying, these businesses were going to be solvent and well capitalized. And we thought there was a disconnect in the market, but we ended up buying, 4 or 5 individual investments, and we sized them all, the individual ones small, but the aggregate was a very heavy weighting for an investment. And so when 2 or 3 investments are really, really similar, we think of them as not 2 or 3 investments, but maybe 1.5 or 2 investments, and size them accordingly. And then when they get big, look, we sell things when we think they're fairly priced. And even though and so some of our energy investments we've sold and no longer own, but some of them are only expensive relative to where they used to trade, not relative to what their underlying assets are worth. And so those, we scale them back, and we have 2 different portfolios we manage, 2 composites, a capital appreciation one and a more aggressive portfolio. The more aggressive portfolio will let names be 15, 20% of the equity of the portfolio. In the capital appreciation, more conservative portfolio, if something gets up to be mid-teen digit percentages, we're scaling it back.
Said differently, the capital appreciation might be a stay rich idea where the more aggressive one may enable you to compound a little bit quicker.
That's right. And if you look at our website, you'll see the marketing material for both of them. They've both done very well over extended periods. I think that capital appreciation has basically kept up with the S&P since 1996, which for a value guy is probably much, much, much better than average. The more aggressive portfolio has done basically 2 times the S&P over 20 years.
So why is that? I guess obviously you're letting your winners run more, but do you think that as far as compounding at high rates goes, is there something about letting winners run that is inherently sort of superior from a compounding standpoint, do you think?
No, not necessarily, Bill. And I'm not sure that's the biggest driver of the difference in performance. I think the biggest driver in the difference of performance is how aggressive we get during periods of dislocation when things become really cheap. On the capital appreciation composite, our rule is we build positions of 3 to 5%. And if it goes down in price, we don't let the market tell us we were wrong and sell it, but we also don't add to the position. So we have, plenty of times names have gone down by 80% in price, and a 4% stake has become a 0.8% stake. In the capital appreciation composite, if it turns out our thesis was right in the first place and it goes up 5-fold to our cost and then exceeds that and doubles again, we'll have a 10% gain in the portfolio from a 1% position. And that's good. In the more aggressive portfolio, we will add to names when they go down. And we will get more aggressive in periods of uncertainty and turmoil. That's the biggest driver, I think, of the relative performance. And the more aggressive portfolio also has a shorting component to it.
Okay.
So we have 20, 30% of the portfolio short, and we end up with more than $1 for dollar long. So we look for a central place to be 125% long and 25% short in the more aggressive portfolio. And so those two things, the portfolio rules mostly on adding, and the leverage and the ability to get short, which gives you an ability to get more aggressive when things go down in price. Because at the bottom of market declines, we have historically had very, very trivial short exposure. So we're functionally getting more long by not having any short. And then we've had more torque on the upside as a result.
That makes sense. A younger me would say, well, why don't you just add to the capital? Why aren't you allowing yourself to add in the capital appreciation portfolio? The older me thinks I know the answer, but I'm going to ask you the question and let you answer. But I respect risk management a lot more than I used to. So I will toss it to you.
I don't know if you could tell by the look at things here, but yes, I've been at this long enough to know the single most important thing is to stay at the table and not to get wiped out. And look, our aggressive portfolio has been around for 25 years and hasn't gotten wiped out. But the capital appreciation portfolio is designed for someone's nest egg assets and a large part of someone's, investable assets. And so it just has more conservative rules. And if we put 5% of someone's portfolio at risk in a name and it goes down 2% of the portfolio, it's designed to be a conservatively structured portfolio. So we don't just add to it. And look, ultimately, investing is tricky and you're going to get some things wrong. And, you can't build a 25, 30 stock portfolio and have it invested over time and not have some things ultimately be wrong soup to nuts and get it wrong. And, we're not willing to burn down the portfolios because for any one name.
I have a lot of respect for that. I think that there's John Hempton once upon a time wrote a piece about not doubling down into losers and whatnot, and people can go read that. But that was it's funny. I think that the younger me used to say, well, if it's down 50% and you're right, why in the world would you not buy more? Or said differently, if you're not wrong or you don't think you're wrong, why would you not buy more? The older me realizes that maybe you were wrong, even though you didn't realize you were wrong, right?
That's right. So
Yeah.
you do want to exercise caution when you do it. We do it in an assertive portfolio, and we don't do it in another portfolio because they're both good strategies for different investors and different risk tolerances. And
Yeah.
the more aggressive strategy has had higher returns, but it's been more aggressive.
Yeah. Interesting. I really like how you said that. That makes like perfect intuitive sense to me.
Thank you.
So, it's funny. Like, but I learned from reading Buffett, right? I have a lot more to learn, probably by rereading Buffett and thinking more about it. But I hear one of the quotes that he says, is I'd have 50% in my best idea, and I think about like how I used to interpret that and how I do now. And boy, has it changed with age. And my definition of what my best idea would have to look like in order to have that kind of a position. I haven't seen one in my life, I don't think.
The notion of having 50% of an investment portfolio in a name, I don't think that that's a good portfolio structure.
Yeah, I don't have the stomach for it.
Well,
But I think sometimes value people because of, and I don't mean to lay the blame at certainly not at the church's feet, but because of Munger and Buffett, I think there's some sort of pride in concentration. And I don't necessarily, when I was young, I felt it, and maybe I'm just internalizing, but I think, like I said, as I've grown older, I've got children now. Like, I'm not trying to take a hero shot at something and blow it up. So if you got a vehicle that you're saying is for the people's nest egg, I fully respect rules around it.
right. And look, our job is to build a diversified portfolio, not bet the portfolio on one or two ideas.
Yeah. Yeah. Did you see something in your younger years that made you sort of lean this way from building a firm perspective? Or was this something that kind of inherently made sense to you?
When I started out investing, I tried to make sense of, what worked as an investment and what didn't work as an investment. And it was really challenging because there didn't seem to be a lot of correlation between any particular facts and the near-term movement of any security. And people were judging success based on 3 and 6 months. And when you're starting out, and 2 years is an awfully long time, it's hard to know that things are going to work out well over 2 or 3 years. So what I was able to do is find a bunch of securities that I was pretty sure you'd get the rate of return that they were offering because they were able to pay their bills. So I started out as a high yield bond analyst, and my first investment was a Pan Am Equipment Trust Certificate. There was a plane in the world that had a $30 million value, 18 million of the bonds outstanding, trading at a discount. I was paying $15 million to get a $30 million airplane. Well, okay, I'm paying $30 million, the $15 million, the plane's worth $30 million, and I'm getting, that's an 11.5% coupon trading at whatever price, a discount to par. And then I'm like, okay, this company has these bonds outstanding. This is the cash flow they're generating. It's super stable. It's going to grow at these rates. This is the free cash flow. This is how they're going to delever over time. Okay, this is the rate of return you're getting. The business can sustain that valuation. And then I was lucky enough to have the fellow running the risk arbitrage research effort leave the firm and ultimately help Leon Cooperman build Omega Advisors. And when Charlie left, I took over his mandate to do research on risk arbitrage names. And he had a list of about 15 securities that were in some state of either being bought out or going through reorgs. And in each of them, the modus operandi was that something was going to happen where an economic participant was going to take control over these entities and you were going to get some rate of return. And so you had to decide whether that buy was a good buy for the buyer. And if so, how big a spread you were going to get and what your rate of return was going to be. So it was all about asking yourself, what price will a rational buyer pay for this asset? And it was a really diversified group of assets. So it gave me a quick learning curve on valuing a bunch of different things, from bankruptcies to financial companies to supermarkets to all sorts of stuff.
Yeah, that's neat. Now that you've been doing what you've been doing for a while, have you figured out a little bit better what makes an investment work, quote unquote, from those that don't? I mean, are there any commonalities that you've seen that somebody pitches you something and you're like, I don't know about that. I've seen enough of those not work.
It's good to always keep an open mind. The thing that I do super consistently is say, all right, like what do these guys have? And why do I think that's worth more than I'm paying? We bought Rivian this week.
Oh, yeah?
Yeah. Yeah. You know what they have?
Well, they got a hell of a brand.
They have a hell of a brand.
And they've got a truck that is put together. My understanding is that the components in that truck are, like, I think they have McLaren brakes in that. That's the rumor that I heard. So I think that the probability that it's a solid product is quite high. Outside of that, I don't know where you're going with it.
Well, right. They have a great brand. They've spent a lot of money building the infrastructure to get a product to market. They have a very solid anchor client in Amazon, and they have $9 billion worth of cash. And it's an $8 billion equity valuation with a couple of $1 billion worth of debt. So you're getting the $10 billion that they've invested in building their business and the share price in cash money.
Yeah.
And yeah, the product I think is great. I think it's as good a vehicle as you could buy. And I hope I'm right, because I just bought one.
I know a couple people that have them that rave.
And look, I think electric EVs are the future. And I think that there will only be a couple of standalone EV companies. I think, having a startup EV company is really, really hard. I think that Tesla will probably be around. But I think the other EV companies, one of them went bankrupt, in the process of spinning out of control right now, Fisker. And it's highly unlikely that they have a going business, that there's a Fisker out there a year from now. And that means that anyone who bought that car is going to have a doozy of a time finding service.
Yeah.
Which the knock on is going to be to any other standalone EV maker. It's going to scare buyers.
Yeah, you would think.
The notion they may not be around. Yep. I think Rivian will be around because they have that big pile of cash, and because they have Amazon as one of their bigger shareholders and a core client of theirs who is committed to buying a certain number of trucks over an extended period. So I think they'll be around. And I think their product is great. And I'm getting it at cash on the balance sheet, basically.
Yeah. So the market's telling you they're going to burn the cash, and the entity is not economic, right? And that becomes where you focus on. Is this a true implied assumption that the market's telling me?
That's right. That's right. And look, that's a very legitimate perspective. And there are other EV companies that I don't think will make it. And so, cash or not cash and not enough cash and not happening. And so the devil is in the details for sure. And there are judgments and questions involved. But the soft details around Rivian are pretty good. The Amazon backing them as an idea, they, to my mind, have as good a product as is out there. And, I say that as a consumer. Now, I felt confident buying their truck because they seem to spend $150,000 on building it. And I only gave them $100,000.
That's what I was going to go. But now this is where the business concern comes from, right? Though, is that if you were to disassemble the truck, my understanding is that the cost that they have in the truck exceeds the retail price.
Well, that's right. And that makes it a good buy for me. And a bad investment.
You're correct.
But I don't think that math stays true over time. This company started producing trucks 2 years ago, 3 years ago. They're ramping up production. They're doing, their run rate is 50,000 trucks a year, 57, 60,000 trucks a year. That's not scale. And the prices of the inputs that they contracted for early days were high numbers. But I'm pretty sure that electric vehicles are fundamentally cheaper to build than internal combustion vehicles. That over time, the simplicity of the electric motor compared to an internal combustion motor is just really, really different. And the battery technology, at today's level is a viable technology. And so the only pricing driver on the battery is the commodities that go into it. And those commodities have been volatile in price, but they're not inherently rare commodities. So, and some lithium companies obviously have had huge margins and the negative margins and blah, blah. But the battery prices, because they're driven by commodities that are highly likely to become cheaper, those prices go down. So the EV vehicle will be the cheaper vehicle to build for apples to apples. And people who build them will probably earn a positive rate of return on them if you have a brand value and efficient manufacturing operations. And I think these guys have those things. So, when the equity was valued at $30 billion, we're like, well, maybe that'll work, but seems like a lot of risk in it. When it's at $9 a share and $9 billion, $8.5 billion, and there's $9.5 billion of cash, the risk reward is just really different. And all the soft facts around it are really positive. I think they're the best management going. I think it's a really, really well-built car. I think the brand management has been spot on. Mr. Bezos has sort of done a good job building businesses over time. I'm happy to have him be on his side of the table. When I look at Amazon, it's not a cheap stock. When I look at Rivian, it's a very cheap stock.
You said it's important to keep an open mind. Here, I'm looking at your portfolio. I was like, I got to figure out energy questions. Now we're discussing Rivian. Blows my mind.
One of the things we do really well is build a very diversified portfolio. And it's not diversified with 200 names that are all the same, but it's diversified with 25 investments that are all really different. What's the same always is the underlying assessment, so what do they have and what's it worth? And who do they owe and how much and what am I paying to get at it when I buy this instrument?
Yeah, I love it. What do you think about Comcast? I'm somebody who does follow cable reasonably well. It has been punch after punch, although Comcast has weathered the storm quite a bit better, in part, I think, because of the parks business, and their leverage is quite a bit less aggressive than some of the peers. So I think they've, and are arguably their operations are better. But curious when you see maybe underlying signs that things are going well, but the stocks, whether it's because the sector or whatever, remain weak. How do you think through that?
I believe in patience. Time goes by and you don't know when the truth will out, whether it's this month or 3 years from now. I think what's good about Comcast is they generate huge amounts of cash flow. Their businesses are, for the most, they're in transition, but they're not in decline. The management's been better than any other management, I think, that's comparable, and that's evidenced by where they are as in terms of scale and scope in that space. They're big and competitive and strong. The underlying assets, you could easily make a case are worth 50% more than today's share price, if not more, if you start doing your sum of the parts, etc. The stock's been dead money for 2 lifetimes.
It has felt like that.
It's been dead money for 2 lifetimes. But Look, it's one stock out of 25 that's been dead money. When will it double? Maybe in the next 12 months, maybe in 2 years. The values are accreting day in and day out. Look, they're generating value from owning high quality assets. And so, if that value is growing by 10% a year or 7% a year or 14% a year, something like that. And so the longer it stays at this price, the cheaper it gets. And, we've seen that happen before, and then you get a catch up, and the catch up is profound, and you just never know when it's going to happen. But you want to be in a bunch of different things so that any one of them could be doing that on a given day or month.
Okay, so we've talked about a few different concepts. I would characterize Comcast as a fairly stable earnings stream today. I would say energy generally certainly looks a lot better post 2020 than it did pre 2020, and maybe that sticks, maybe it doesn't. The history of commodity companies makes me a little bit skittish. And then you've got Rivian, where the earnings stream is on the come. Do you manage those types of investments differently? Do you compare, do you have a model that's sort of the flight path and you're comparing results to the model? Like, how do you manage thinking in so many different ways?
Part of it is that after we have a thesis and an understanding, we stop thinking about it too much. I mean, we'll revisit the numbers and we'll look at it again and ask ourselves if we're wrong. But I haven't spent that much time thinking about Comcast over the past couple of years, a little bit here and there. But I think I know what the drivers are, and I think I'm monitoring them, and I think I'm waiting for that to play out. And then we own Air Lease, which owns a fleet of aircraft and leases them out, and the planes are worth probably 50 to 70% more than the share price than the enterprise value, which means a lot more to the equity because there's torque there. And so, the work of this job is looking for new ideas and understanding where the opportunities are being created today. And because we tend to hold things for a year, 2 years, 3 years, 4 years, you can spend a lot of time looking at different things and have really diversified exposure because the investments tend to be long-lived.
I'm more asking this as I'd love to just pick your brain and learn. When do you think about revisiting a thesis, right? Do you have sort of key metrics that you're tracking? And if this is off base, then maybe I need to revisit, because there's a fine line between over tinkering and then being overly lazy, right? So I haven't quite figured that out. I tend to tinker more than I should.
Yeah, I hear what you're saying. There are times when I feel the most important thing we could do is sit on our hands and make sure we don't touch anything. But when it comes to revisiting theses, it has to be really organic because any given measure has its flaws. You revisit it when it goes down price by 20%, 30%. If it's not going down in price, but things are going wrong, it's a really good time to get out of it. Probably just as important to be aware of exactly how the investment is playing out when it's stable in price as when it's gone up or down. Because, to get out without any damage when you got it wrong.
It's a beautiful thing.
Yeah,
that's called luck. And we could all use more of it.
Or paying attention.
Fair.
Or tinkering too much.
Yeah. Well, sometimes it works, sometimes it doesn't.
Right. But look, that's where some people execute well and others, they have all the data. They just aren't, don't pull the trigger at the right moment.
Well, I know I've been a pretty good seller. The holding part I could work on, but I don't know. Maybe I'm not sure that says I'm a good investor at all, but I'm always working on it, trying to get better. So over time, hopefully.
Well, that's right. And it's, the nice thing is it's a thinking man's business.
Yeah. Just can't overthink it, but in our background, you had mentioned that you had a view that we were sort of approaching I guess you had said an overextended bull market peak. You said we're likely to get there, but we're not there yet. And I'm curious to hear you riff on that and talk about why you think that.
Sure. Well, the simple reason why I think we'll get to a bull market cyclical peak that's overextended is because I think that market cycles exist, and that we're in a market cycle, and exuberant tops happen, and I have happened in the past, and I think they'll happen again. Why do I think it's 3 to 5 years in front of us, which is through 2 years, 6 years, 8 years? Well, because these cycles tend to be long-lived, and the market trough was, let me look at the calendar, 2024, 2008. We're a number of years into an advance.
So you would not reset on the COVID pullback?
No, absolutely not. If you look at the market advance from 1978 to 2000, which was 22 years, you had the market break of 87 and then the recession of 91. Those two things, gave you corrections over a 20-year period, and big ones, 30-ish%, whatever. I see COVID as more of that sort of phenomenon within a longer term advance. And obviously we're at higher levels than we were before COVID. So the advance is intact. Now, then the question is, okay, so why do I think that this is not the top, right? And the answer there is because there's froth in this market in certain places and areas. But the amount of froth relative to global GDP in 1999, 2000 is just orders of magnitude different than the amount of froth today. And I'm not a quant. I'm not going to prove that to you mathematically, but I was there and I saw the numbers in terms of total market caps of very, very small businesses. And they were really big relative to US and global GDP, not relative to a $2 billion revenue-based business. And so I don't think the level of extension today is anything like it was in 2000. And because I think there are cycles, I think we'll get there. And I think there are a lot of, sort of anecdotal pieces of data that suggest we're sort of on the way.
What would those be?
Well, there are exciting new technologies that are driving innovation in the year 2024. I don't know where the blockchain goes, but in 1992, I didn't know where networking technology was going to go. It gave us the internet 5 years later or whatever, and it was happening. AI, obviously, it is going to have a big impact on the world. The electrification of transportation is a major transformative phenomenon that's going to play out over 20, 30 years. Those kinds of things, and what's happening in medical technology is just amazing right now. I mean, the pace of new things that are coming out of labs that are curing cancers and fixing obesity there's a lot of technological innovation happening. And that tends to create, a bit of a gold rush. Where investors
also a lot of stimulus,
and plus
right?
A lot of stimulus. No lack of stimulus in the next several years. We've adjusted to higher interest rates, so we might have a bump in the next 6 months, but I don't see why we wouldn't go to an exuberant peak. Like, what's the argument against that this is the top? It's not extended like other tops have been extended. That's just probably easy to demonstrate mathematically.
Yeah, well, so the other thought that you had that I thought was very interesting was that so the sentence that you wrote was go growth names bring you to the ultimate top. Less exciting companies don't participate. The key is to buy true growth stocks trading at value prices, which you had said earlier. If you simply buy cheap stocks, they will underperform into a major top. I was curious as to why you said that.
Well,
the cheap stock part.
Well,
they get left behind?
For sure. In an exuberant top, what people buy is what's fun. People talk about stocks at cocktail parties. They talk about getting rich on this crazy new company. The shoe shine boy gives you tips. He doesn't give you a tip that, Bank of America is at points to one and a quarter times book and JP Morgan's at 1.7 times book. So he's like, these guys are going to have helicopters that are going to travel around the world. And so, yeah, it's the gold rush stuff that gets everyone's attention. And yeah, other investments that are staid and boring get left on the sidelines. And, in 1999, 2000, value managers were just quitting. They had underperformed dismally. 2000 came, 2001 came, 2002 came, and value managers didn't see the same declines as the growth guys. But you had to still have a portfolio to have had it mattered. And an awful lot of people, and what happens in those excited moments, I think, is that people stop doing the boring stuff and switch into the exciting stuff. And that's what makes it a bubble, and that's what makes it a top. And you asked me, like, why do I think we're not there yet? There are moments where there's a lot of where the public is interested in investing. But, the degree of interest in investing today is not consistent with the shoe shine guy giving you stock tips. And I think you'll get there because I believe in cycles.
Yeah, well, if you'd asked me in 2022, was 2021 the top? I would have said, yeah, maybe. I would have said probably, like 70% sure. But now I don't think that's necessarily true. You've seen you've seen a lot of companies sort of pop, whether it was Zoom or whatever, but the bull market runs on. And, at least for good quality companies and the value factor has outperformed since 2020. So, there's still a lot of cheap stocks out there, I think. I may be wrong when I say that, but I believe that to be true.
No, I think you're right. And the stocks that are richly priced are richly priced for very good reasons. Like NVIDIA is a very, very expensive stock, and it'll take 20 years for that company's business to grow into that market cap. But they're a really well-positioned company that is doing a fantastic job. And arguing that it's frothy, a little, but not a lot. And you look out to places where there are companies, that are consequential market caps that are really, really frothy.
Yeah. Yeah, that's part of the I guess the Mag 7 debate, for lack of a better term, that I find a little bit like makes me want to yawn, is exactly what you're saying. I mean, if you look at a lot of the Mag 7, at least, specifically Microsoft, Google, Facebook, Amazon, I mean, just the sheer amount of compounding of wealth, like true economic value that they have done is incredible.
Global scale, dominate important businesses, disrupted the world. These are real. Like, you could argue whether the PE is right or wrong, but you can't argue that they are not exceedingly valuable businesses.
Yeah. Well, I think about it sometimes like baseball. Eventually, you're the team that overpays Albert Pujols, but the teams that rode that wave up, it carried them for a very long. Well, one team carried the Cardinals for a very long time, right?
Yeah.
So,
I'm going to agree with you.
It's interesting.
I have no idea what you're talking about.
Well, he was very, very good, very good. But eventually, somebody signs a player to pay him too much. I'm sorry.
I've off of professional sports.
I'm sorry. I saw a little video the other day. It was like Game 6, and no one was in the stands, and somebody just said, like, this is about right. But hopefully their fortunes turn at some point. Interesting. So what do you get excited to come to work to do? I mean, are you somebody that just like loves learning and then the investment ideas flow from that? Or do you enjoy being the entrepreneurial side of building the business? Like, What gets you going at this stage?
I love finding great ideas that I find really, really compelling. I mean, that's to me the best. When you trip across something and you first see it, you're like, yeah, whatever. And then when you turn it over and turn it over and turn it over and be like, wow, this is great. Like, I don't know if I'll make money for sure, but it's highly, highly likely. Yeah, that totally motivates me. Finding those good opportunities and gaining confidence that they are good opportunities, long or short.
Yeah.
And I like
Yeah,
it
it's a
when they
fun.
work out. It's much more pleasant.
Indeed, it is for everyone involved.
That's right.
I mean, I guess the short side, less for everyone involved, but I would argue it's good for the market to have shorts be right.
Look, sometimes companies get too frothy and they're scams and shams, and it's better that they get identified sooner rather than later. And you're only making money on a short if something's wrong. And so, identifying something wrong sooner is better than later.
In your experience, does shorting a company that has things going in the correct direction but is frothy, is that strikes me as a much more scary proposition than looking for the ones that are truly have like deterioration under the hood and sort of pressing those.
Yeah, I think of it as the inverse of a value trap. When you have a business that is declining in value and declining in value and declining in value, you might buy it cheap, but you're going to sell it cheaper. Shorting a great company whose business is growing and the underlying value is growing just because it's too expensive is a very foolish idea for two reasons. One, because ultimately the tide is against you, right? Because they're growing in value. And two, the fact that you figured out that's overpriced, so has everybody else. Like, everyone knows it's expensive, but expensive stocks can get much more expensive, and they're expensive in part because they get culty and they generate an investor base that have passion around them. And those go to high prices. So, you know, the upside risk is not that it, goes to 50% overvalued, but that goes to 4x or 5x overvalued. And, if you're starting at 3x overvalued and you're going to 5x overvalued, it's not a good place to be, especially when the value is growing over time. And look, we don't always get it right when we look for those things. And sometimes we think business conditions are deteriorating and they're not really. But our effort is to find things that can't last. And investors are sure they will last. Yeah.
Who do you look for in analysts? Do you like to hire somebody young and train them up, or do you prefer to hire somebody that's got some experience?
My move has always been to hire novices and let them grow into learning the process. I have a mindset and a strategy of how we look at investments, and I'm not really looking for someone to come in with a different strategy that I learned from. I strongly prefer to have people fresh to the business to grow into responsible roles.
Yeah, that makes sense, especially given, I think, your path in.
Yeah.
Yeah. Cool. Well, I got to tell you, man, I've enjoyed this. This has been, I racked my brain. I said, all right, how am I going to talk to him about energy? Because it's not something that I really know about, and it's stuff that other people really know about. And here we are. We talked about everything but energy, except for that you accumulated it when it was very asymmetric to the upside.
That's right.
And that makes a lot of sense to me.
That's right. And look, we have some energy names we're short today because the valuations don't make sense relative to the underlying assets. And we have a lot of long exposure, which is going to go down if energy prices go down. So we're happy to have some short exposure so that if energy prices do go down, we make money on those.
Yeah. The thing that I get hung up on is just the and it's probably a mental block, and maybe it's changed, but it's an industry that tends to not have the best capital allocation histories. But maybe that's an assumption. And
No, you're right and you're wrong. You're very right for the period from 2000 until 2000 whatever, 2016. Not so much for the past or whatever it was, 2000. It's been a while since energy companies have been profligate. There was a long time that energy companies were profligate. And part of that was around the shale innovation. They figured out how to get energy out of formations that we knew it was there, just couldn't come out. And then they figured it out, and it drove a lot of investment. And they got exuberant, and too much capital went in, and returns went negative for a really long time. By the time we really built our exposure in 2021, I guess, we'd gone a long time of underinvesting in energy, and everything was idle. All the offshore rigs were idle, all the land rigs were idle, and it had been a long slog down. And, you made a comment about commodities going down in price over time. And I was on a TV program in 2000 or so. And I was on with Jimmy Rogers, who started with George Soros in the 1960s, one of the best investors going for a long, long time. And he's an investing powerhouse. And he said, yeah, it's, buying commodities, they've underperformed for a long time. Like, come on, they haven't gone anywhere in 20 years. I look at the commodity index, and it has a base value from 19 whatever, and it was 100. And by the way, the thing is 105 now. So, I don't have to be that good at the math to see that they've gone nowhere. And he was like, yeah, but these are long cycles. And the next 8 years, man, was he right and was I wrong? So, yeah, sometimes they're just long cycles, and sometimes, and look, energy has been a good investment, over many, many long periods of time. And it went for an extended period where you're right, it was terrible. But that's one of the important things to think about in terms of what you are willing to look at and what you're not. Because in 2000, I was like, yeah, commodities. And I was like, well, wait a minute. Turns out that was wrong for an extended period. So
yeah. No, I'm trying, right? I'm open. I've done work on energy. I've been surprised at some of the results, and the one I'm kind of kicking myself for is I should have bought Valero a couple months ago, but alas, I did not. And we'll see. I've done it long enough to know that there's a good chance the shares come down to where I didn't buy them, and we'll see if I
won't buy them again.
That's probably true. You're not wrong. So, all right, cool. Well, thank you so much for your time. I appreciate it. And I hope it was enjoyable for you.
Yeah, you made it really, really pleasant. Thank you very much for spending the hour with me.
All right. Well, take care of yourself.
Take care of you too. Thanks.
All right. Bye.